Hi, everyone. Thank you for joining me today. As we approach the end of May, for most Australians, thoughts may turn to colder weather, shorter days, the looming threat of school holidays. But for those dialed in today, this time of year can mean only one thing, and that's tax planning season. So without any further ado, I'll launch into the topics that will be covered today. Some important information just on the screen, which you'll have available in the background. Now, there's a number of ways you can work through the major year-end planning points, but we tend to favour breaking it up according to taxpayer profile, namely individuals, trusts and companies. There will always be some overlap across two or more categories, and those represent the general guidance that you can see on the slide there that can be applied more broadly. So let's start with individuals. Starting with individuals and the looming tax three-stage cuts, making this 2024 the final year before taxpayers receive a material adjustment to their personal tax position. Now, it feels like a long time ago that we had the announcement of the final version of the stage 3 personal tax cuts. What will it entail? A reduction in the first band from 19% to 16%. In the second band from 32.5% now down to 30%. The 37% rate is pushed back to starting at now $135,000, and the 45% rate is pushed back to $190,000. Now, this represents a tax saving for someone on a salary of, say, $190,000 of around $9,000. But equally, and bringing it back to year-end planning for 30 June 2024, that means bringing forward a deduction in the 2024 year provides a greater tax benefit for any individual who claims in 2024, as opposed to letting it fall into 2025. For example, say I'm on a salary of $190,000 and I can bring forward an expense claim of $20,000. That represents an immediate $800 benefit if I'd left that deduction until the next year. And of course, then there is the consideration of franking credits and dividend strategies from private companies that are looking to plan a tax-neutral outcome for dividends paid out to shareholders. So with the change in rates and the bands, 2025 provides an opportunity to pay a higher fully franked dividend to shareholders to obtain the same neutral outcome. Assuming a company works to a rate of 30%, this means a cash dividend of $139,000 can be paid next financial year, compared with a $116,000 dividend paid in 2024. Similarly, a company that works to a franking rate of 25% can pay out a cash dividend of close to $100,000 in 2025, compared with $75,000 in 2024. Now, unless directors are committed to paying out a dividend before 30 June, and that can sometimes be the case, we'll talk about Division 7A a little later, holding off until 1 July could represent an increase of close to $23,000 that companies can get out to their shareholders in the way of fully franked dividends and still ensuring a neutral tax outcome. I'll talk further to franking dividends under company year-end planning. Okay, so these are some of the general items that we talked about earlier that, while common for individuals, they also overlap into the other entities, but it's convenient to talk about them now. Firstly, the comment timing is everything. We just spoke briefly about the benefit of bringing forward deductions, and the changing rates nicely illustrates this. But in any event, there's also, of course, the timing benefit of having that tax saving in your pocket 12 months or more earlier than if you leave it into the next income year. Likewise, an individual's circumstances may be such that income need not be recognised for 2024. When can this come about? An example might be the terms of a particular service contract and the conditions for when the service provider actually becomes entitled to the income. That may be with the performance or completion of certain tasks, in addition to the issuing of a formal invoice. So there's an opportunity there potentially for deferral of income if commercially it hangs together. As with our reference to large transactions, if someone has a property on the market or is contemplating putting a property on the market, if circumstances permit that they can be delaying contract date until after 30 June, they again get an immediate opportunity to defer that assessment for over 12 months. Gifts and donations, always check the deductible gift recipient status if you're counting on the deduction. Consider who should be making the deduction. You may have a couple looking to make a deduction. One of the couple is on a much lower taxable income, such that they're paying a lower amount of tax, or they may not have or be earning any taxable income at all, in which case focus on the higher taxed individual to have them make the donation and to have the donation receipt in their name. As for tax losses, if you're sitting on any unrealised tax losses leading into the end of 2024, stop to consider whether it's appropriate to be bringing forward a loss by realising that particular asset or investment. Whenever doing this, it is key and critical to remember that the tax office does have some Part 4A weapons in its arsenal when it comes to what are referred to as wash sales. That's most broadly where a taxpayer may realise an asset, knowing that they had a gain in that year, generate the loss, but take steps such that they never actually really lose the beneficial interest in that underlying asset. And that can be two forms. That could be they actually dispose of that asset to a related entity that they also control, or they may sell and then buy the same asset back on the same day on the market. One to be watching out for. Other items for individuals, not necessarily critical for year-end planning, but worth remembering. The working from home deduction for this year has increased to 67 cents per hour. Now, with that increase came an additional change, which was to include internet and phone expenses within that fixed claim. The ATO actually issued a warning only recently for taxpayers who may inadvertently double dip by claiming the 67 cents per hour, but separately still claiming a deduction for internet and phone expenses. Jumping over to HECS, as always, in the next few days, there's an opportunity to pay out the HECS debt and therefore avoid the indexation charge for this year. And for 2024, you'll see from the slide, we have that identified as 4%. Now, strictly speaking, that's not correct. At this stage, that is a proposal that is yet to be enacted into legislation. So presently, under the law, that indexation rate is still 4.7%, but the government has said that there will be a retrospective correction. Moving on to super, and again, the year-end planning opportunity here is as much about noting what's coming down the pipeline as it is about the current benefits. Now, firstly, the obvious one, if taxpayers have yet to maximise their available concessional contribution for 2024, being $27,500 for individuals, then now is the time, if they have the cash available, to get that full deduction before 30 June. Similarly, taxpayers wanting to maximise their non-concessional contributions claim, and depending on just how much they have at their disposal in terms of funding, if they're deciding whether or not to do a single year or a 3-year bring forward, at this time of the year, they could do well to pay simply 1 year's worth of non-concessional contribution and delay the 3-year bring forward until 1 July next year, therefore effectively getting 4 years' worth of non-concessional contributions in a reasonably similar period. Also, by putting or pushing back your non-concessional contributions to next year, and the 3-year bring forward in particular, could see you being able to access an additional $30,000 of non-concessional contributions per individual, noting the increase that's coming down the pipeline in the 2025 income year. Now, sticking with the topic of superannuation, downsizer contributions. Again, one to be aware of and relevant for year-end planning in terms of circumstances permitted, achieving that balance between when you make your non-concessional contributions and when you avail yourself of the downsizer contribution. So just working through briefly in terms of the key rules, we have a maximum entitlement of $300,000 that's available. Now that's per spouse. So therefore $600,000 for a couple. With only one of those couples or one of those persons needing to be the owner of the house if they live together. The duration is the most important criteria here. It must be that you've owned the house for at least 10 years. And when we talk about time or length of time, it has to also be that you're over the age of 55 at the time when you're making the downsizer contribution. Also, stop to ensure that you would have been eligible for the main residence exemption in any event, because that's another important criteria for the downsizer contribution. If your property happens to be pre-CGT and under the normal main residence exemption rules, you'd actually therefore not be eligible for applying main residence. You get to deem an assumed treatment or characterisation as post-CGT and then apply the main residence rules and the exemption criteria as normal. The other requirement, and this is the one to talk about when it comes to planning, is that you have within 90 days of settlement or an extended period, if the Commissioner allows, to make the non-concessional contribution. This is where a consideration of shuffling non-concessional contributions and the downsizer contribution could be relevant, depending on when the taxpayer finds themselves selling their house and when their 90 days expires. If settlement has already occurred this year, let's say in the last month, for a taxpayer, and they have the decision as to when to make their downsizer contribution, important to note the interaction between the downsizer contribution and the transfer balance cap. Now, the downsizer contribution itself is not subject to the transfer balance cap. However, it will influence the transfer balance cap. So currently, when we work to a transfer balance cap of 1.9 million, if our superannuation fund is already at 1.9 million or close to 1.9 million, then we can still make the downsizer contribution without there being any limitation. However, if, say, our current balance in our superannuation fund was 1.6 million, and we then made our downsizer contribution, that would take our transfer balance cap to 1.9 million, therefore preventing any further contributions. Now, assuming you're dealing with a balance of 1.6 million in the 2024 year, and your 90 days does not run out until after 30 June 2024, you may wish to make your contribution, or you may wish to make a non-concessional contribution, if possible, in the 2024 year, thereby taking you up to the 1.9, knowing that in the next year you can make your downsizer contribution, therefore being able to take your effective balance beyond the 1.9 million in your superannuation fund. Now, that's a very broad description of how the superannuation and the downsizer contribution rules work, and I would emphasise that they would need to be considered in detail and recommend that you obtain specific advice on doing that kind of a strategy. Very briefly, worth a reminder for taxpayers as they think about their tax position for the year. What are the focus areas of the tax office? Work-related expenses, rental income from holiday homes, rental property deductions. All of these are what you'd ordinarily expect to see. Interest deductions with hybrid bank lending products where there could be a mix of both private use and commercial use. and testing whether or not interest is being claimed on funds that are actually being used for private use. And then there's the data matching powers that have been recently afforded or expanded for the tax office, such that they get an even closer insight into things like cryptocurrency trading and also the e-commerce businesses, for example, Uber, other rideshare arrangements. The ATO now has broader access to those so that they can identify taxpayers who have what you might, or what is colloquially referred to as a side hustle in addition to their ordinary job. The tax office now has access to information to identify if those taxpayers are not declaring the income made from those pursuits. GST registrations, not surprisingly, with what happened still relatively recently in terms of the loss of $4.6 billion by the ATO under false GST business registrations, is a focus area. And so now we turn to trusts and year-end planning. Not surprisingly, the biggest watch out for trusts leading into year-end are distributions, ensuring that those distributions are done correctly. Followed closely by taking the opportunity that you have got your beneficiaries in place to effectively receive those distributions. So while the focus can often jump immediately to what is the tax outcome of those distributions, depending on where those distributions are made, often what can easily be overlooked is whether all of the steps have been complied with in respect to the rules regarding trust distributions in order that that distribution is actually valid in the first place. And so you can see from the checklist that we have on the screen the relevant items to work through. Firstly, consider the trust deed and also the constitution of the corporate trustee. Now, the trust deed will require that a decision needs to be made by 30 June 2024 in this case, and failing that, there may be a default beneficiary clause that you would need to be aware of. If your distributions are not in place by 30 June, then you may have an outcome resulting in either the trustee being assessed to the distribution, or it could be worse, a beneficiary that was not intended to receive any income this year. Consider your definition of income, making sure to understand just exactly what it is that you're distributing for this year. Is it defined as taxable income? Is it defined as accounting income or income according to trust law concepts? Now, depending on the definition of income, that can have very different results in terms of what the anticipated benefit is that passes to beneficiaries. And the importance of considering this at 30 June is that often your trust deeds can give you the flexibility to decide by 30 June as to just what the character of the income will be that you are distributing. Beneficiaries. It's critical to make sure that you have effectively nominated beneficiaries and that they are in fact eligible beneficiaries as defined under the trust deed. Also, review family and interposed entity elections. It is critical that you make sure that any distributions from a trust to another entity does not risk attracting family trust distribution tax if the distributing trust has made a family trust election and that beneficiary falls outside of the family group. Consider trust streaming. If you are proposing, if the trustee is proposing to distribute franked dividends or capital gains in one direction, whilst distributing other classes of income in another, while this is permitted under the Tax Act, it does come with conditions, and you must make sure that you're aware of those conditions under the legislation. Evidencing that your trust debt resolutions are made in time. I touched on that briefly when talking about the trust deed, but also the constitution of the corporate trustee as well. Over the last 10 or so years, the tax office has issued communications as to what constitutes a valid decision to distribute by 30 June. Now, it doesn't necessarily have to be a signed minute by 30 June. The critical condition is that there is evidence that the trustee had resolved as to how they would distribute. This could be, at one extreme, some notations on a napkin, but also an example commonly used by practitioners can be a diagrammatic representation of the intended distributions, with arrows showing from the trust where to the intended beneficiary is. And that's something that could be initialed by the directors of the trustee, evidencing that they had resolved by 30 June to make those beneficiaries presently entitled. But it's also important to consider and remember the constitution of the trustee company as well, because often there is an additional need for a decision by directors of a company to be considered valid, and that may be in the form of a minute or a resolution, either that must be signed at year end or must be done within a certain period post year end. So whilst the tax office has said that it's happy to see some form of evidence other than a company minute or resolution as at 30 June, the ATO will often point out that you still need to follow it up with a minute within a reasonable period of time, or certainly within the rules or the period dictated by the trustee company constitution. Focus on intention and ensure that that is consistent with the deed. I'll touch further on the case of Owies in a moment, but whilst tax benefits and tax considerations may be foremost at the mind of a trustee when they are resolving to do their distributions, they should always turn their mind to what the overriding objective is of those distributions. Obtaining tax file numbers from beneficiaries before the distribution. Now, this is critical because whilst we talked about the decision to make a resolution or a distribution by 30 June, if there's technically an absence of knowledge of the tax file number of the intended beneficiary, that may attract TFN beneficiary withholding tax. Now, the tax office can apply some concessions here in cases where you're distributing to related entities, and it's reasonable to expect that there is a knowledge by the trustee of the tax file number by reason that the director of that trustee is also a director of the entity, or they may themselves be the beneficiary that is receiving the distribution. However, I'd caution against relying on this. And also, I would recommend that if any new entities are being set up, contemplating them as beneficiaries by year end, that is done as soon as possible, if not already, to ensure that a tax file number application can be made in time and the tax file number received before year end, such that the tax file number can be disclosed to the trustee when distributing. Taking care on proposed distributions to loss entities or lower taxed entities leads perfectly into our next slide. So I would expect that most people on this call would be familiar by now with section 100A, given the level of commentary around it in the last few years. Broadly, 100A is aimed at capturing distributions to lower taxed beneficiaries, where the benefit is actually enjoyed by another entity who may be taxed at a higher rate, such that tax is saved on distributing to the purported beneficiary, whilst the benefit is always really enjoyed by the other person. Had the distribution gone to them in the first instance, they would have paid a greater amount of tax. Therefore, section 100A is designed to capture such arrangements, and the penalty that applies is to tax the trustee at the top marginal rate on the income that has been so distributed. The Tax Office issued several publications, including guidance on what they see as what I'll call green zone or red zone type arrangements, which will determine whether or not the Tax Office would see these as distributions which would attract their attention and give them pause to consider whether to apply Section 100A. Also worth remembering, if the ATO is reviewing your distributions and your history of distributions, there is an unlimited period of review that applies in respect of Section 100A. So what, for example, are green zone distributions? The most common or the most straightforward green zone distribution would be a distribution, say, to a family member. That may be to a young adult who is on a relatively low tax rate. And if a distribution is made to them, that distribution is satisfied shortly thereafter. That is, that a payment is made directly to that beneficiary, or a payment is made on their behalf to a third party. But either way, there is a clear benefit to that beneficiary, and the unpaid entitlement has been discharged within a relatively short period of time. The Tax Office puts a period of time of 2 years on that period. What we have on the slide in front of us are alternatives to the discharge of an unpaid entitlement. And these are some examples where the income may in fact be retained by the trust and used for working capital in its business operations. You have there what are known as Scenario 3B arrangements, either a distribution to a company or a trust, or a Scenario 3A, where it's a distribution to an individual who controls the distributing trust. Now, in each case, there is an expectation that whilst these entities are not calling on the funds, they are compensated. And that may be through commercial terms, that may be through Division 7A terms, i.e. interest and minimum repayments. But the important thing is that the fund, even though it is used by the trust for a commercial purpose, that is, as working capital or in an investment asset, that of itself is not sufficient. There must be a commercial return back to the beneficiary in recognition that they are not calling on that income. Covering briefly, an obvious red zone arrangement, which is really what we touched on at the start of this discussion. A distribution goes to a lower income individual associated with the trust, so they are made presently entitled to the income as at 30 June 2024. As I said, that may be a young adult who is not generating much income as yet. It may be a spouse, it may be a relative. And then the actual underlying cash passes to another individual who ordinarily, had they been made presently entitled, would have paid a much higher rate of tax. Not only that, but in these cases, these red zone arrangements, it may often be that that is followed by an extinguishment of any entitlement that the individual who is presently entitled to the income may have through either a gift or a debt forgiveness or an interest-free loan. So key themes and takeaways for Section 100A. Look to those distributions to family members. Note that distributions can be satisfied by taking account of expenditure that has been met by the trust throughout the year, as long as a schedule or evidence is maintained to demonstrate that expenditure that has been met by the trust. And you'll see at the bottom there, the action item is try to maintain contemporaneous record keeping and evidence, document those dealings. One thing that would not be accepted by the tax office is to be taking account of expenditure incurred by a trust on behalf of a minor. So that may be private school fees when they were a secondary school student, which are then slowly discharged by the beneficiary through the receipt of the distributions once they become an adult. That would not be accepted by the tax office. Moving on to trustee retention of funds. Again, remember that they should be put on commercial terms or they are paid out within a reasonable period. Also, in the case of distributions that are made to loss entities, similar to when we looked at the red zone arrangement for an individual that is never having to pay back its the loan that is made to that individual. If a distribution is made to a loss entity and that loss entity in turn provides a benefit onto a, so, and if that loss entity does not call on those funds, then again, that may attract a red zone treatment. Look out for, in particular, artificial or contrived arrangements. So that could be exploitation of accounting versus tax differences, where again, you may see through the benefit of timing of tax deductions that a beneficiary in 1 year may receive a nominal accounting distribution, but the taxation associated with that distribution is extremely high. That beneficiary could be someone who is taxed at a much lower rate or even exempt from tax, whilst at the same time, the subsequent year, a distribution of a very substantial amount of accounting or trust law income is made to a beneficiary, which again, because of timing, and that same timing, has a very low taxable amount allocated to it. Also, watch out for circular flow of funds. That is what's regularly seen as the washing machine, a trust that distributes to a corporate beneficiary that it actually owns, and that corporate beneficiary then paying a dividend out to that same trust, which again then distributes through to the corporate beneficiary. Another issue to consider when it comes to trusts and for year-end planning is whether or not any actions need to be taken to shore up deductions within a trust group or within entities associated with the trust group. Now, in recent years, there are authorities such as Chadbourne and Federal Commissioner of Taxation. Prior to that, there was also the taxation determination issued by the tax office, which considered deductibility of expenses associated with support that is provided to discretionary trusts. So this comes back to ordinary principles of deductibility and the interaction between that and a beneficiary's mere expectancy of a distribution from a discretionary trust. So the clearest example is if a beneficiary was to loan money interest-free to a company in which they're a shareholder, and in order to make that loan to that company, they have actually borrowed from a bank and they're paying interest. Now, subject to the exact circumstances, that individual may be able to claim a deduction in respect to that interest cost on the basis that it has funded support that that individual is providing to a company in which it is a shareholder. By that individual funding the company, it is not unreasonable to expect that that enables the company to increase its working capital, to therefore increase profits, thereby increasing potential dividends that can flow back to that individual. In other words, there has been a nexus that's been able to be demonstrated between the receipt of future income and the cost in the form of the bank interest. Now apply that same scenario, but instead of a company in which the individual is a shareholder, the recipient is a business trust of which the individual is a discretionary beneficiary. in that case, the individual cannot point to a expectation or a reasonable entitlement to any future income out of that trust. Because that trust has discretionary powers as to who it distributes to, the beneficiary cannot be saying that any costs it incurs in terms of supporting that trust are incurred in connection with earning or deriving assessable income. So as I have written on the slide there, receipt of discretionary distribution equals an insufficient nexus. Now, taking that from the case of an individual to what we see in many of our clients' trust groups, and that is an operating entity or the costs entity that incurs all of the costs to maintain the group. So in this case, we've described it as a management entity. It could be a family office entity. Either way, it's a cost centre. It incurs things like salary and wages. It may incur the lease expenses, fit-out depreciation, etc. Now, in the past, the practice has often been that trusts within the group each year will distribute to that loss entity, thereby offsetting the loss that the entity is generating from incurring all those costs incurred in supporting those trusts in their investment or business operations. But applying Taxation Determination 2018-9 or applying Chadbourne, the Commissioner may argue that the management entity is not entitled to the deductions because it cannot create the nexus between that and the derivation of income, given that that income is nothing more than a mere expectancy rather than a legal entitlement. Therefore, in those situations, what groups may wish to do, and they may wish to do this before year end, is to consider locking in any management agreement terms through a management agreement, ensuring that the management entity can recover any of its costs through an on-charge to those trusts, thereby effectively still securing the same income from those trusts just by way of a management charge now rather than a discretionary distribution. And that could be the difference between those expenses being deductible and being treated as non-deductible. Finally, as a consideration, perhaps for the new year, subject to the particular circumstances of a client group, they may wish to consider restructuring from a trust to a company. What are some of the benefits? Lower tax rate, either 30% or 25%, simpler management of Division 7A, which we'll talk to shortly, reduced risk of Section 100A, and also noting that subject to the size of the client, they have not necessarily foregone the benefit of CGT concessions, either securing that through the sale of shares or, if they're eligible for the small business CGT concessions, still being able to access all of the relevant concessions, irrespective of whether the operations are now done through a company. And that's our segue to talking about companies and year-end planning. So again, some standard year-end items to consider. Again, a number of these are general items which could be equally applicable to individuals who are operating businesses or trusts, but it's suitable to also deal with them here. For bad debt write-offs, remember, in order for that bad debt write-off to be a deduction, it must be a reasonable assessment. And also, you should look to some form of written record evidencing the decision to write off the debt as bad. That can be an accounting entry, but it need not be. There can be other forms of written evidence as long as they're signed off by someone who's in a suitable position to make that call. Trading stock elections, again, there is always the option under Division 70 of the Income Tax Assessment Act to value your stock at cost, market selling value, or replacement value. And that may suit you for a variety of reasons, but one may be if you know that the market value of your trading stock presently is quite low, a revaluation could bring forward a deduction in a year when it's needed. Prepayment of expenses. Whilst it is difficult to claim prepayments fully for expenses these days, there does remain the opportunity with certain specific categories of expenses or depending on the profile of the taxpayer. So statutory charges are one that is eligible for a prepayment deduction, such as land tax, motor vehicle registration. Also, remember, in the case of small and medium business taxpayers, subject to the 12-month rule, they're also eligible to claim a full deduction on the prepayment, irrespective of whether the service period spreads over into the next income year. Finally, bonuses and accruals. So for a company that is an employer, always worth remembering that whilst a bonus may not have been paid out by year end, it is possible to claim a deduction for those bonuses, so long as you can demonstrate two things. One, that there is a clear, definitive commitment by year end, and two, that that commitment is capable at the time of quantification. Now, when I say at the time, that need not be that the employer can actually calculate or has written down what the amount is at year end. It just means that all the factors are in place such that when performing a calculation later, that calculation can be performed with respect to 30 June without there being anything that remains as a variable that is not resolved until after 30 June. So an example may be a formula that determines what the bonus is that is to be paid, and that may be referable to EBITDA. The fact that nobody knows the exact number of EBITDA at 30 June does not matter as long as there's no variables or discretion as to how that EBITDA is measured after year end. Then the bonus should be quantifiable as at 30 June. Moving on to Division 7A for our private corporate taxpayers. So again, it's good to work through the checklist in this case. Firstly, be conscious of what the benchmark interest rate is for any minimum yearly repayments that need to be made by 30 June 2024 on your Division 7A loans. These calculations should be getting made now. Identify all intercompany transactions to make sure that you have not missed any that might be treated as especially payments or debt forgiveness. Otherwise, you risk having an immediate Division 7A exposure as at 30 June. So again, important to check all of your intercompany transactions leading up to 30 June. Loan documentation should have been in place by now, should have been in place by the due date for lodgement of the tax return. Now, for some out there, if they have secured a formal extension from the tax office in respect to the lodgement of their company tax return, this may still therefore be a date that is yet to come. And so having loan documentation in place is something relevant to still be aware of now, as we're doing this presentation on the 28th of May. If you have a formal extended date for lodgement of your company tax return for the 2023 income year. As we say, make sure that your current year minimum yearly repayments are actually paid. So you need to make sure that you have a strategy in place as to how you will be paying those minimum yearly repayments by 30 June. That may be through cash, or that may be through other physical forms of property, including an assignment of some form of tangible right or some loan receivable, as long as it's properly documented, that can constitute a valid form of payment. And that goes on to our other discussion point, which are franked dividends being declared if those dividends are being used and as a form of receivable that can in turn then be applied to meet a minimum yearly repayment. Also, when you are determining your repayments, make sure that there is no risk that within a reasonable period of time of that repayment, there's actually a redrawing of the same amount. If that's the case, and that may be also prior to making this payment, then there is a risk that that will be treated, or that minimum yearly repayment will be disregarded. Also, finally, ensure that you have traced through transactions through interposed entities. Don't just confine your tracing and your analysis to your primary company. Interposed entities can still be caught depending on the payments they make. Moving on to a discussion on unpaid present entitlements and the Commissioner's ruling. So, we now know that the Commissioner will no longer accept sub-trust arrangements going forward. The Commissioner's position is that the sub-trusts will not negate the treatment as financial accommodation, and therefore any unpaid beneficiary entitlements, in order to avoid being treated as deemed dividends in the subsequent year, must be put on Division 7A loan terms by the following year or be paid out. Actually, I'll just correct what I referred to in terms of the timing. For an unpaid present entitlement that arose as at 30 June 2023, under the Commissioner's ruling, 2024 would see this now be treated as a loan. As a loan for Division 7A purposes, you will then have the ability to document that or pay that loan out and avoid Division 7A deemed dividend treatment by the lodgement date of the 2024 income tax return. Now, there are some exceptions to that, and it's very important to be across the rules as expressed in Taxation Determination 2022-11, because in some cases, you may not get that additional year deferral for the unpaid entitlement to be treated as a loan and then be corrected. Having said all that, we do note the case of Bendel and Federal Commissioner of Taxation, where the taxpayer was able to successfully argue that an unpaid entitlement did not give rise to a Division 7A loan from the corporate beneficiary, that it was not in fact financial accommodation. Now, we do know that the ATO has appealed to the Federal Court and issued an interim decision impact statement saying that it will stand by its views and the application, and also the potential application of Section 100A to those entitlements. So what does that mean for us at year-end planning time? All I'll say is a decision or a call would need to be made by the client as to whether they continue to be cautious and document any loans that are due to be documented as Division 7A loans or due to be paid out in order to ensure they are not treated as deemed dividends, or adopt a wait and see approach. Now, for 30 June 2024 distributions, there is time before you would need to take action, because this would not be treated as a loan for Division 7A purposes until 2025. But for 2023 distributions and making a decision as to how that will be treated and making a call as to whether or not to rely on Bendel or to adopt a conservative treatment and document the arrangement or pay out the loan, that day is fast becoming. Also worth keeping in mind for existing subtrust arrangements, those prior to the Commissioner's announcement, effective 1 July 2022, those subtrusts may still continue. Furthermore, when those subtrusts expire, there is the opportunity to then put them on loan terms and thereby secure an additional 7 years of financial accommodation. Currently, we can expect to be seeing 2015 distributions that have transitioned from a subtrust to a loan that would have needed to be documented as a Division 7A loan by lodgement date for the corporate entity, and the first minimum yearly repayment needing to be made by this 30 June. So important, if you are adopting a strategy of extending the life of your subtrust into a Division 7A loan, you need to make sure you're aware of which subtrusts have expired and are now requiring to be put on Division 7A terms. At this stage, a 2015 trust distribution must be documented and a minimum yearly repayment must be made by this 30 June. Moving to something else entirely, instant asset write-offs for companies. So we have there a question mark. Where do you stand at year end? Well, this is because there is continuing uncertainty because the bill to enact the instant asset write-off has yet to be passed. The bill, having passed from the House of Representatives, was amended by the Senate to increase the threshold to $30,000 and extend the application to medium business entities, and has been returned to the House of Representatives. However, this proposal has in fact been rejected by the House of Representatives, and so we have a standoff at the moment. And therefore, the question mark is whether you can rely on the eligibility of the instant asset write-off for the 24 income year. Whilst don't hold me to it, the safe bet is probably to apply the instant asset write-off to yourself as a small business entity, therefore with $10 million or less of aggregated or less than $10 million of aggregated turnover. And if you are relying on the instant asset write-off, work to the lower cap of $20,000. Finally, company tax and franking rates. Important as you get to year end to ask yourself what your income position is, what the history has been of your income as a company, and whether that sees you treated as a base rate entity for the 24 income year, and what that may mean also for any franking of future dividends. So we know the conditions for the application of the base rate entity: 25% rate, aggregated turnover less than 50 million, passive income must be equal to or less than 80% of the income generated by the company. The franking rate for any dividends will apply the same test, but will be referencing the prior year. This is important to remember for the franking of any dividends. And I've just had my lights turned off, which is telling me that we've probably almost reached the end of our presentation. So what I'll say about company tax and franking rates, noting the difference between when the taxation rate applies to the company and when the franking rate applies by reference to the prior year, you do what we call the base rate shuffle. So consider now your future dividend payment commitments What was your treatment for the prior year? If that treatment was as a base rate entity, but you have reason to believe that going forward, you may move out of base rate entity status, do you delay or do you bring forward your dividend payment? Going forward, you'll also need to be considering your income mix. What will that mean for your treatment going forward? What was your treatment this year based on active versus passive? What was your treatment last year? If you're making a decision about the franking rate that you want to apply, review your franking account. If you are choosing to pay a dividend and the prior year you were a base rate entity, your franking credits will be limited to a 25% rate. And the question you need to ask is, do you risk permanent surplus in your franking account? This is an important exercise to do. And when it comes to companies with very, very substantial franking accounts, it can make a big difference to the end tax outcome to a shareholder and the potential loss of hundreds of thousands, in some cases millions of dollars of franking credits if you get the timing wrong. So we'll leave it there. I do note that we've run out of time, being 1 p.m. Thank you again for your time. If you have any further questions, please feel free to contact Pitcher Partners with the relevant contacts on the slide in front of you. Thank you everyone for your time.